Distinguished panelists, participants, ladies and gentlemen, welcome to the second and final day of this joint Asian Development Bank Institute Conference on Development and Innovative Finance. My name is Bruno Carrasco. I'm the Director General of the Sustainable Development and Climate Change Department at the Asian Development Bank, and I am delighted to chair session 3 on greening micro and macro-prudential frameworks. Today, we have a most impressive lineup of speakers, including Fernando Restoy from the Bank for International Settlements, Cornelia Holthausen from the European Central Bank. We have Chris Faint from the Bank of England, Ms. Darian McBain from the Monetary Authority of Singapore, and my colleague Junkyu Lee from the Asian Development Bank. Climate risk is very much a clear and present danger. As I highlighted in yesterday's opening remarks, the Asia-Pacific region contributes to approximately 50% of global greenhouse gases. And we are disproportionately affected by climate-amplified natural disasters, resulting in loss of lives and livelihoods, and of course, significant destruction of the infrastructure that underpins our economies. Today's session will focus on climate-related macro-financial risks and how to capture these physical and transition risks in central banks' macro-prudential frameworks. This is a challenging area, no doubt, as well as we will hear from our presenters. And given the pervasiveness of risks and how to internalize the resulting externalities. Data gaps are significant, as we know, and the pathways over time, and bearing in mind changes in technology, are fraught with a high degree of uncertainty. Against this backdrop, rather, we need to, of course, press and recognize the important role that central banks play in supporting an orderly economy-wide transition towards the net zero goals and objectives. Now, before we begin, I have a few housekeeping notes. Today's session is being recorded to be available for viewing post-conference. Each of the 3 presenters today will have a total of 20 minutes to deliver their presentation. This will then be followed by 15 minutes of discussions with our 2 discussants. Finally, we will open it up to a question and answer session, open to the floor for some 10 minutes or so. I therefore would like to ask everyone to please keep to time. If you have any questions for the presenters, for all the participants, please use the Q&A feature in the Zoom webinar. Please indicate the presenter's name for your question. We will hold questions until the end of the session, and I will then read questions out loud for the presenters to answer, time permitting. Now, let us begin. Please welcome our first presenter, Mr. Fernando Restoy, Chair of the Financial Stability Institute, Bank for International Settlements. He's been Deputy Governor of the Bank of Spain from 2012 to 2016. Fernando, the floor is yours. Thank you.
Many thanks, Bruno. It is a real pleasure to participate in this ADBI-ADB joint conference on development and innovative finance, where distinguished speakers are discussing highly relevant issues for the financial system, the current challenging environment. So the organizers have asked me to participate in this interesting session on the implications of climate change for regulatory policies, and I'm of course very happy to do so, given the relevance of this topic for the financial sector. I think there is now broad agreement, as Bruno was saying before, that climate change is driven by human behavior and proceeding faster than expected. Climate developments pose potential challenges for nearly everybody, and most certainly for banks and the financial system. Moreover, financial intermediaries are bound to play an essential role to facilitate the immense reallocation of resources that the transition to a sustainable economy will require. Slide 2, please. So let me first describe the main risk the climate developments pose for the financial system. I will then refer to different roles that regulation can play, in particular to protect the safety and soundness of financial institutions, and also to facilitate the transition towards economic sustainability. In that context, I will refer briefly to the possibility for regulation to offer either a penalizing treatment of brown exposure or a favorable treatment of green exposures, now discussing several jurisdictions, and finalize with a few concluding remarks. Next slide, please. So, as we all know by now, financial institutions are exposed to climate change, mainly through two different sets of climate risk drivers. First, banks are exposed to physical risks. Particular banks may suffer the economic costs and financial losses resulting from the increasing frequency of extreme weather events like waves, floods, and wildfires, longer-term climate shifts, such as changes in precipitation, ocean acidification, and rising sea levels, and also from the indirect effects of climate change, like soil degradation and drought. Second, as jurisdictions seek to address climate change by reducing greenhouse gas emissions, their efforts may generate transition risks. And this is because economic disruption could stem from the cumulative effects of changes in government policies and technology and consumer and investor behavior. And this in turn could erode the value of banks' credit exposures or the corresponding collateral. So by and large, the climate-related risks faced by financial institutions broadly fall under the risk taxonomy used in prudential regulation. In particular, physical and transition risks manifest themselves in the form of credit, market, and liquidity risk. In addition, climate-related developments can increase operational risks by affecting business continuity and by giving rise to litigation and reputational losses. So, given the impact of climate change on traditional risk categories, the case has been made that prudential policy needs to be adjusted to account for the impact of climate-related risks on the safety and soundness of financial institutions as part of the core mandate of supervisory authorities. That could be called the financial motivation for regulatory action. Moreover, this adjustment has often been presented as a contribution by prudential regulation to facilitate the transition to a more sustainable economy by providing incentives for a more climate-friendly allocation of financial resources. That will be more or less the economic motivation. But the financial motivation presents substantial technical complexities that supervisors need to assess, if only to avoid unintended consequences. For its part, the economic motivation may not be as straightforward as it may seem, given the substantial trade-offs involved in prudential policy. So let me now examine these two topics in greater detail. Next slide, please. So when consider possible regulatory adjustments, the first question is whether current rules already capture climate-related financial risks. If that were not the case, regulators will need to consider supplementary actions through modifications to Pillar 1 instruments, such as the risk weights used for the calculation of regulatory capital ratios, Pillar 2 requirements as part of the supervisory review processes, or Pillar 3 disclosure obligations. Indeed, the Basel Committee, as international standard setting body for banks, has announced the roadmap to identify gaps in the Basel framework so that it can develop measures to address them. However, quantifying the potential impact of climate-related risks on banks' overall risk profile poses formidable challenges. First, physical risks may evolve over much longer time horizons than the 12-month time frame typically used to measure capital adequacy under the current Basel framework. And second, techniques used to translate climate scenarios into financial risk rely on a wide range of simplifying assumptions. The results of these projections are subject to uncertainties, including unpredictable course of future green technological developments and climate-related government policies. So those two complexities make it challenging to use standard Pillar 1 instruments, such as risk weights, to address climate-related risks. Capital requirements are designed to ensure that banks have sufficient loss absorption capacity to cover losses in the face of unexpected developments. Thus, risk weights should be calibrated with an implicit value at risk type of methodology. The idea is to measure losses for specific exposures in contingent scenarios occurring with a predetermined probability over a specified time horizon. So that means that in principle, an adequate calibration of risk weights for climate-related risk exposures will require an estimate, at least a rough one, of the whole probability distribution of climate-related events and associated policy reactions. In addition, given the long time horizon of the relevant projections, one will need to ask how banks might respond to emerging risks in these scenarios. In other words, asking banks to set aside capital today to cover losses for risks that may only materialize long after the maturity of most of the current exposures, and only if their investment strategy remains unchanged over long time horizons, does not sit well with the underlying construct of regulatory capital requirements. Slide 5, please. So supervisory action under Pillar 2 offers more possibilities to deal with climate-related risks. Authorities could use their supervisory review processes to assess firms' exposure to such risks and seek, within a reasonable period of time, changes in firms' approaches to identify, monitor, measure, and control them. That may well prove to be more helpful than direct capital requirements to mitigate the impact of climate-related risks on banks' financial positions. Sectoral concentration limits could also be used under the Pillar 2 if deemed appropriate. So beyond this, if additional loss absorption capacity is considered necessary, the imposition of capital add-ons under Pillar 2, based on the suitable scenario analysis and stress testing, could be more effective and upward adjustments in risk weights under Pillar 1. Climate stress tests allow, at least theoretically, the potential impact on banks to be considered in the light of different scenarios that combine specific climate developments and actions taken by policymakers and the banks themselves. So those exercises can therefore facilitate the derivation of a scenario contingent impact estimates of both physical and transition risks on banks within an internally consistent framework. Supervisors can then use those exercises to require either management actions or additional loss absorption capacity or both. A number of supervisors are currently asking banks to prepare transition plans. In some cases, those plans incorporate strategies to adjust banks' exposures to specific scenarios set by the supervisor in such a way as not to compromise their solvency positions over the specified time horizons. So on that basis, the supervisor would identify persistent and unjustified deviations from the plans that could be factored in the regular Pillar 2 assessments and eventually lead to a capital add-on. In any event, as a starting point for any prudential measures, granular taxonomies are needed to support the assessment of banks' vulnerabilities, especially for corporate exposures. Moreover, these assessments need to be based on comprehensive scenarios, including climate developments and the policy responses. In addition, standardized regulatory returns need to be developed that contain sufficiently detailed information on the relevant climate-related risk exposures. So fortunately, the international community is already working hard to fill the current gaps in information and analysis. In particular, the network of the greening of the financial system, and the FS has developed a suite of plausible scenarios, and these are already in use by regulators to analyze the vulnerabilities of their supervised institutions. The Financial Stability Board has also made progress in developing guidance for climate-related disclosures, which has now been adopted in many jurisdictions. And these efforts are complemented by actions such as the initiative by the IFRS Foundation to establish public financial disclosure standards of sustainability through the creation of the International Sustainability Standards Board. So those developments will certainly help regulators to adjust policy and in particular to adapt their supervisory frameworks on the Pillar 2 to the implications of climate-related financial risks. But having said that, the same flexibility that makes the Pillar 2 framework such a powerful and effective approach may give also rise to level playing field issues. The international guidance on the application of Pillar 2 to address climate-related financial risks will therefore be a very welcome development. So slide 6, please. So turning now to the economic motivation. Certainly promoting a swift transition to a more sustainable economy should be the primary objective of general government policies. It is true, however, that regulatory actions, such as the ones described before, aiming at addressing banks' climate-related risks could provide financial entities with incentives to reduce exposures to firms and sectors that are most vulnerable to physical and transition risks. Therefore, while not being its primary objective, prudential regulation could, in principle, help facilitate the distribution of credit flows across sectors that might support the transition of the economy towards a less carbon-intensive, productive structure. Yet, I think it remains uncertain how far prudential policies can contribute to that social goal by themselves. Moreover, complex trade-offs may be generated by too great an emphasis on prudential tools with a direct climate-related macroeconomic objective. First, while regulatory penalization of exposures to borrowers subject to physical risks, such as extreme weather events, may have a clear micro-prudential rationale, this does not directly help to mitigate those risks or to smooth the transition to a greener economy. If anything, it may even exacerbate the impact of climate risks on unprotected firms and households by reducing their access to bank financing. With regard to transition risks, more stringent prudential requirements for exposures to agents holding significant amounts of stranded assets will strengthen banks' resilience. But at the same time, though, it will also reduce the availability of funding for firms and sectors with a relatively large carbon footprint. And this could possibly help with the required economic restructuring. However, the quantitative impact of carbon penalizing prudential requirements on the actual credit supply may not be that significant unless it becomes really large. And if this were to be the case, the affected companies will become less capable of shifting to more sustainable production processes, thus hindering the transformation of the economy as a whole. That is why I think prudential actions aimed at penalizing firms and sectors that are dependent on fossil fuels might exacerbate transition risks by increasing the vulnerability of a potentially large and economically significant set of borrowers. In this light, there seems to be limited scope to directly use prudential regulation to try to mitigate climate-related risks for the economy as a whole without generating friction with its core financial stability objective. Applying a green supportive factor to alleviate prudential requirements for green exposures so as to facilitate the transition is unlikely either to mitigate frictions across policy objectives. So by reducing capital requirements for green assets, the unexpected losses that could arise from those exposures will by definition be insufficiently covered by own resources, by capital. Moreover, such an approach would also encourage the overvaluation of green assets in relation to their fundamentals. So these two factors would increase the risk for financial stability and also the scope for friction between the financial stability mandate of regulators and general policies aimed at favoring the transition to a more climate-friendly economy. So those trade-offs for prudential regulators are mainly associated with the treatment of transition risks, but they become much less significant if governments adopt a hands-on approach in shaping the transition to a more sustainable economy. Although this is obviously a complex endeavor, a comprehensive and well-defined policy program containing the required mixture of taxes, subsidies, and public guarantees for different activities could not only facilitate the achievement of the climate targets, but also, very importantly, I think, alleviate the transition risks. And in this case, of course, regulatory actions will be far more likely to be closely aligned with the general climate-oriented policy. Next slide, please. So let me now conclude. I think few now doubt the urgency of public policy action to address climate-related risks. In the area of financial regulation, it is now widely accepted that authorities need to thoroughly analyze the financial impact of climate change on firms' safety and soundness, and to consider adjustments in the current prudential framework as warranted to protect the stability of the financial system. But achieving the right balance between disclosure obligations, supervisory action, and if needed, the adjustment of capital requirements will then I think, is a key objective. At present, supervisory actions taken in the context of climate stress tests look somewhat more promising than adjusting formally the capital requirements associated to specific exposures as a function of the estimated physical transition risks. This Pillar 2 approach will, however, require clear guidance at the international level to avoid unwarranted discrepancies across banks and jurisdictions. At the same time, I believe it would not be appropriate to assign prudential authorities a prominent role in the direct public policy response to the climate emergency. This should be left to governments. Regulatory instruments have at most an uncertain impact on the actual transition path towards a more sustainable economy. Moreover, in delivering on their core mandate to preserve financial stability, prudential authorities need to consider trade-offs and adopt decisions that may not always be fully aligned with climate-related policy actions taken in other areas. In other words, I believe that the best contribution regulators can make to societal objectives on economic sustainability is to adjust the prudential framework to the extent needed to rigorously incorporate the impact of climate-related risks on firm safety and soundness. So let me stop here. Thank you for your attention. Back to you, Bruno.
Thank you. Thank you very much for the excellent presentation. We've heard from Fernando Restoy how we can look for the right balance between supervision, prudential regulation, and climate change risks, and recognizing the trade-offs that we face in this endeavor. If you have any questions to Fernando, please add them in the Q&A chat box, and we will be able to answer some of them during the end. Let us now move to the next presenter, who we're delighted to have with us, Ms. Cornelia Holthausen, Director General of the Macro-Prudential Policy and Financial Stability Department at the European Central Bank. Cornelia, over to you, please. Thank you.
Thank you very much, and for the invitation and for this interesting panel. Let me open by saying it's always very good if the panelists have different views. So, and I spotted some aspects of Fernando Restoy's talk where I think I would disagree, and that's the role of the macro-prudential treatment of climate change, because I would like to make the case in the following for such a macro-prudential treatment. Because we do think that there are some aspects that would argue for that. We at the ECB, we had launched a project team to look into these aspects already in 2019. And here the goal was to improve the quantitative basis for evaluating the nexus of climate change and financial stability. And in the 4 years of existence of this project team, they have explored data and identified data gaps. They looked at physical as well as transition risks, and thereby using and expanding scenarios put forward by the NGFS to longer horizons and also to non-bank institutions. And given the evidence found, the report of the group, that is, by the way, publicly available, made the case for developing a macro-prudential approach, and they started looking into potential macro-prudential policy options. Next slide, please. So what did the report of the group find that would justify a macroprudential treatment of climate risk? So in a nutshell, the key analytical findings of the reports can be grouped into a cross-section and a time series dimension. As regards the cross-section, the granular mapping of financial exposures to climate change drivers that was done, that suggests an uneven vulnerability across EU regions, sectors, and financial institutions, and in particular, large concentrations were found. And also the reports found that there are risks of systemic amplifiers, and importantly, credit risk materialization during a green transition might cluster. And as a result, some aggravate fire sale dynamics could materialize due to overlapping portfolios in the case of an abrupt reassessment of climate risk pricing. And there's also a time series dimension of systemic risk in the view of the study, because the study looked at how climate shocks would ripple through the financial sector, and it's found strong interdependencies across financial players and markets. And in the view of this group, it's not enough to just look at individual banks if we want to tackle these type of risks. Building on the analytical findings that I just highlighted, the report makes a case for developing a macro-prudential approach. Such approach should be risk-based in line with the prudential mandate. It should target systemic aspects of climate risks, and thereby would ultimately help to address both climate-specific and also the classic form of externalities. the cross-holdings and common exposures across the financial system and the potential for increased default correlations would likely amplify the materialization of climate risks. And with a system-wide perspective of a macro-prudential policy, such an approach could help to address risks that cut across sectors and then limit arbitrage. And by covering all relevant parts, it would help to alleviate possible spillovers between the banking and non-banking sectors, and it would help to reduce cross-sector arbitrage and limit risk shifting to the less regulated part of the financial system. The report also discusses the interaction of macroprudential policies with other policies. So obviously, macroprudential policy cannot work in isolation, but it has to work in tandem with a microprudential counterpart that Fernando just talked about in a way that complements and ideally reinforces each other. And of course, there are also a broader set of public policies aimed at limiting and adapting climate change that it will need to interact with. The report also discusses some concrete policies. So for the banking sector, several candidate macroprudential tools have been identified for further assessment, including capital buffers and concentration risk measures. And for the non-bank sector, similarly, concentration risk measures, but also the need to address the insurance protection gap and strengthening market standards were mentioned. So I will elaborate on this in the following slides. Next slide, please. Yeah, let me first put the macroprudential policy into the wider context. So to be very clear, the idea of macroprudential policy is not to combat climate change or to change policies that enable the economy to cope with climate change. That's something that political processes should deal with. But still, the unprecedented global nature of climate change and its impact on the financial sector in particular, they call for a broader policy response. So together with the supervisory efforts and the macroprudential regulation, macroprudential policies and considerations would play an important role in addressing the challenges of climate change for the financial system, focusing on the systemic aspects of climate risks. So a consistent macroprudential approach that covers all relevant parts of the financial system, and it would target systemic risk both at the individual sector and cutting across sectors. Let me go to the next slide, please. So such a joint effort of micro and macroprudential policies would be subject to policy interplay and would indeed require a strong effort to coordinate across the relevant authorities. And as I tried to illustrate in this chart, some measures may form part of both micro and macroprudential approaches because their application could be motivated from both perspectives. So therefore, a close dialogue is really needed, and also an agreement who's responsible for what. But there are also, of course, aspects that either one of the policies should address. And finally, let me just stress, because climate change is a global phenomenon and may have far-reaching impacts for the global economy, the global coordination in addressing this risk is really important. So therefore, there's a need to develop standards at the international level. Next slide, please. So sorry for the big table, but we thought we group here together some of the candidate macroprudential tools that we think, where there's the strongest rationale for considering them more carefully. So first of all, there's a systemic or sectoral systemic risk buffer. So this buffer is already part of the European macroprudential toolkit. It aims to cover systemic risks that are not covered by the capital requirements regulation or by the existing buffers. So therefore, it could be used as a general tool to guard against systemic aspects of climate risks. It would also allow for a sectoral application and could therefore be used to contain the buildup of risk concentration in climate risk relevant sectors, and at the same time enhance the resilience of banks against the materialization of climate risk. Another area that was considered by our group is to look at concentration thresholds. So these could incentivize banks to reduce the concentration of their exposure to carbon intensive or to geographical regions exposed to physical risk. That could take the form of a non-capital based tool that is targeting concentrated exposures above certain threshold. And they could also be designed such that the breaching of certain thresholds for relevant exposure triggers, trigger supervisory scrutiny, and or requires banks to explain how they will address concentration risk. And then finally, we think there could be a role for borrower-based measures that could help to address climate risk at the loan level, for example, by distinguishing between mortgages backed by energy-efficient houses and less efficient houses, or for houses that are particularly exposed to physical risks. Next slide, please. The group also looked at a long list of other measures, but these were found to be less promising or less relevant for the task at hand. So in a cost-benefit analysis, in the end, the group thought that these were less suitable, and therefore let me not go into detail here, but you will find them on the slides. Next slide, please. So as I said before, it's not only the banks, it's also the non-bank financial sector that we think should be within the remit of macro-prudential regulation. Could you please move to the next slide? Because I'd like to recall that climate risks that are cutting across sectors, and there's a need to limit arbitrage, and this calls for a broad scope of the regulatory response. Sorry, I don't see my next slide. Thank you. So for the investment funds and the investment firm sector, we think that the clear classification of a fund's investment strategies to address climate change risks reflected in their marketed material is important to avoid greenwashing and to help encourage the funding of the transition to a low carbon economy. And here further regulatory action might be considered. And in particular, should the upcoming disclosure requirements prove insufficient to address the greenwashing concerns and to ensure that minimum safeguards for ESG funds are in place. And additional measures to address the concentration of climate-related financial risks in investment funds and firms could be investigated. This should be consistent with any considerations on addressing concentrated risks in the banking sector. And on the financial market side, it was found that a future mandatory standard for green bonds may be needed to ensure comparability with a view to enhance investor confidence in this asset and again to mitigate greenwashing. Turning to the insurance sector, it's very important to address the insurance protection gap in some form. And here the design of insurance policies can address the structural causes of the private insurance protection gap to some extent, and additional ex-ante public-private risk sharing solutions may be needed to close this gap. And last but not least, the report highlights the need for enhanced disclosure rules to both foster market discipline and to support the assessment of systemic risks stemming from climate change. And here, developing a set of key standardized forward-looking metrics and targets would help. And to improve the comparability of key forward-looking metrics, public sector guidance would very likely be needed. And next slide, please. So this is actually my final slide with the summary takeaways, and I would like to summarize the finding of our group's work. So first, the group found that there was limited reduction in climate risk concentrations so far, and these are at risk of systemic amplification. The group saw that only a limited meaningful reduction in emission intensity of financial system exposures over the last year, although there was some shift away from highly climate sensitive activities, for instance, in the areas of mining and quarrying, but still they found significant risk concentrations in some other sectors. Second, scenario analysis suggests financial system-wide market risk shocks could feed into credit risk. Climate shocks initially impact market risk, so non-banks, followed by credit risks, thereby affecting banks directly. And here, financial system risk propagation potentially can amplify revaluation losses up to 4 times. And a third focus area was building a case for evidence-based macro-prudential policy, including international efforts to ensure systemic resilience. Macro-prudential policy would be needed to address the systemic aspects of climate risks, complementing micro-prudential efforts. For the banking sector, candidate macro-prudential tools have been identified for further assessment, and a broad perspective is advisable as climate risk cuts across sectors and it is a global phenomenon. So the work of the group will continue and will produce a new report by the end of next year that we will then also publish on our website. On the policy side, the main goal will be to develop a more concrete view how existing evidence could underpin a macro-prudential toolkit. And for this purpose, the team will develop further the analytical approaches for assessing climate risks and tailor them to support macro-prudential policy instrument selection and calibration based on a cost-benefit analysis. In my annex slide, you find also the link, I think, to, here at the bottom, you find the link to the reports. Thank you very much.
Thank you very much, Cornelia, for an outstanding presentation. Somewhat in contrast to the first presentation, with the focus on systemic amplifiers of climate risk and focusing on macro-prudential tools. Again, for those participants who have questions, please put them into the Q&A chat, and we'll take them up at the end. Now, turning to our third presenter, we will listen to Mr. Chris Faint, Head of Division for Climate at Bank of England. Chris, the floor is yours. Thank you.
Hello, and thank you for inviting me here today. It's really important that we have events like this to share our thinking in what is an incredibly complex policy area, as I think we've seen from the previous two presentations. Today, what I wanted to speak about is the bank's evolving approach to climate. It builds on the essential foundations from the presentations that you've just heard, and what it explores is how we're seeing risks changing in this space. And the bank, we've been looking at this agenda for 7 years now, and I think it's fair to say that our remit and our understanding of risks has constantly evolved. So I'll try and bring out a bit of the flavor of that. Today, I'll try and split my presentation into 3 parts. I'll start off very quickly by providing some background on the bank's work, its current breadth, and the areas that we're focusing on. I think often the work seems a bit intangible to those that listen. So what I'll then do is, to make the work a bit more tangible, I'll turn to our recent scenario exercise and draw out some key results and charts to explore what they're telling us about the current state of risks, what we're seeing, and how that is relevant to us as a central bank. And then I'll finish by exploring a couple of the areas where those results are impacting the work that we're doing and some of the thinking that we are undertaking. Just the next slide, please. I won't dwell on this, but just for completeness, I've included this slide. It's really just to show that, you know, climate is a strategic priority of the Bank of England now, and there's 5 different areas that we undertake work in, and they are incredibly broad. I think it's fair to say that they touch every single directorate in the Bank of England now, from a monetary analysis to the management of our buildings to the management of our own asset portfolios. But it is also fair to say that at the very, very core of the work that we do is the micro-prudential and financial stability work to understand risks, how they arise, and then think about what that means for how they're controlled, and whether we should be undertaking the usage of any of our tools to help control those risks. And that's really been the core of where we've been investing our money. So I won't dwell on this slide, but if we go to the next slide, I think it is important to flag that there has been an evolution in how we think about climate risks. In 2015, when we started, we were focused on the risks in firms, banks and insurers, thinking through how they could crystallize, generally over shorter timeframes, and what tools would be required to help firms understand these risks that at the time they didn't have a good understanding of at all. Essentially, our focus at that point was from a macro-prudential lens. But over time, it's become increasingly clear that that is just not enough. We have a financial stability objective, and the risks from climate change will have an impact on the whole economy, as Cornelia has just set out. So, and also it's complex. There's feedback loops coming through to the financial system from a number of angles, some of which we've identified, others no doubt we haven't identified. So we need to understand those areas in more detail. And one of the new things that we've seen come into our agenda that maybe we didn't think would be as prominent as it has been is not just looking at the risks that are on firms' balance sheets, but also thinking through how those risks are going to evolve over the next decades or many decades. And a huge part of our work now is focused on net zero and transition. So in the UK, we've got a net zero target of 2050. So a huge part of our work when we think about risks is what is that trajectory to get to net zero? What does it mean for the evolution of risks? And how can we manage firms through those risks? And we say that with the knowledge that if you go too slow in the trajectory to net zero, there will definitely be risks because you'll be building up physical risks. If you go too quick, there's a real risk of a disorderly transition and the build-up of stranded assets. So we're really interested in understanding how the transition to net zero will work in the UK, but different transitions elsewhere, what that means for risks at the financial system level, and what that means for risks in the firms that we supervise. And in order to do that, one of the key tools that's already been touched on is scenario analysis. Quite frankly, we do not see at the bank how you can understand the risks that are going to arise in the future and also the opportunities without undertaking scenario analysis that goes a number of decades into the future and looks at different pathways that actions can take, thinks through different ways that risks can crystallize, and then the findings of that can then be taken back by institutions to think through how they're going to manage those risks today. And I say institutions because the Bank of England is one of those institutions. Scenario analysis is a fundamental tool for us as we seek to understand risks in firms over time, but also the financial system, and then decide what we're going to do about those risks. And it was for that reason that we, 3 years ago, decided to undertake a system-wide scenario exercise to look at how climate risks would evolve over a long period. And that is a perfect segue, I think, into my next slide, which goes into that exercise. And sorry, the next slide after that, into that exercise in a bit more detail. And the reason that I want to talk about this exercise for a chunk of my presentation today is that I think these exercises really do shine a light on the kinds of risks that we've already heard about in a way that does make it tangible, but also confirm some of our priors. And it's really important to confirm our priors with analysis where we can. So a bit of background on the exercise, which we called the CBES, the Climate Biennial Exploratory Scenario. It was launched a couple of years ago, but because of COVID, we delayed the timing and the results reported in May. And unlike our normal stress tests, where the results are typically a direct linkage to capital, we had very, very different objectives, unique objectives, I would say, actually. The first one was to assess and catalyze improvement of participants' climate risk management capabilities, i.e., we wanted to focus minds and get them to invest in their understanding of the risks. The second one was to better size the financial exposures of participating firms and the financial system more broadly to climate risks, i.e., to shine a light on the risks that are on firms' balance sheets now, but that would otherwise be opaque, and then add them up at the system level and see what's going on at the system. And the third was to understand the challenges to participants' business models from these risks over time. And to do that, I should say that we used a fixed balance sheet. So what we did was we said, look at how scenarios are going to impact your balance sheet today, assuming you didn't change it over time. And then that becomes a proxy for the vulnerability of today's balance sheet to future climate scenarios. And in terms of participants, we wanted it to be as expansive as possible, given the resources that we had at the time. So we included both banks and insurers, and the coverage of those institutions covered about 70% of their activities in the UK. So 70% of the life insurance, general insurance, and credit lending in the UK. Next slide, please. A quick focus on the scenarios that we use, because I think this is important. For the CBES, what we wanted to do was understand how risks would arise in the system and in firms under different scenarios. So we used three. We essentially bookended what could happen. On one end, we said, well, imagine there's an orderly scenario. Imagine the scenario starts today, which means you get some transition risk, but you limit the amount of physical risks. That, in many ways, is a best case scenario. But I should say, even in the best case scenario, there's still material risks. In the middle scenario, the late action scenario, which is in the middle column here, what we said is let's wait 10 years and you squeeze transition into a 20-year period, which means that you get a more disorderly transition than you would otherwise have received, but you still build down the physical risks at the end. And in the last one, the no additional action scenario, you don't have a transition. You just assume that you continue as you are. And in that one, transition risks are very, very small, but the physical risks continue to build through the scenario, through the 30-year scenario, and the trajectory of the build of those risks after the scenario becomes quite extreme. And these are irreversible risks. So that was the framework through which we looked to analyze firms. But one really, really important point here, and I think this is a point that's sometimes lost when people look at the results of our exercise. These scenarios, they're not forecasts and they're not stresses. They are just scenarios of what could happen through different climate trajectories over time. And I think it's really important. We're not saying that these are definitely going to happen, and we're not going to say this is the worst that can happen. We're saying these are things that could happen that help guide our understanding. On the next slide, please. So the first, to go through each of the objectives and what it taught us, the first objective was to understand the state of climate risk management in firms. What we found was that firms have made a good deal of progress, but there is a lot more to do before firms would be able to understand the risks that are sitting in their balance sheets. And part of that is because firms are on a journey. They need to continue to invest, and this is a very difficult area. But also there's some fundamental gaps that limit their ability at the moment to get to an end state management of the understanding of these risks. And I've set out a couple of them on here. One of them is that there's material data gaps. And that means that some of the areas where they would ideally have information to understand risks just currently do not exist. And that might be because no one has that data, but in some cases, it's because the right questions aren't being asked. Really good example of that is if a bank has a counterparty and it wants to understand the risks that arise from that counterparty, it needs to speak to that counterparty to understand how they are going to manage their risks. In some cases, that discussion's happened and the counterparty doesn't know. In some cases, the discussion hasn't happened. And in terms of understanding physical risks, it's important to get postcode level data, understand at a really minute level how risks are arising. These capabilities are building, but they are not there yet. So our overall finding for this objective is that there's a lot of work to do, but there's a positive trajectory in terms of the work that we're seeing. So go on to the next slide, please. But the second objective was to understand how risks are arising across the different scenario. And I think this is the really key chart here. This chart shows losses across the different types of participants and scenarios over the full 30-year scenarios. And just be clear on scope, for banks, these numbers are credit losses, not traded risk losses. And for insurers, they're losses in invested assets. As you can see in the mustard bars, total climate losses across participants are largest in the no additional action scenario on the right. And in contrast to the transition scenarios, in this scenario, the losses continue to build materially afterwards. So I think that shows the importance from a financial stability perspective and a risk perspective of taking action sooner rather than later, because in the end, the level of risks will be lower. And second, losses across participants, they are quite a bit lower in the early action scenario in the left than in the late action scenario. So it definitely shows that if you just wait 10 years, risks could be quite a lot higher. But one of the things that's really, really interesting about these numbers is that there is a huge amount of uncertainty on these numbers, and they could be, and they hide a lot of risks within those charts. So to draw that out, if you look at the blue chart in the middle for the late action scenario, what it suggests is that the additional amount of impairment over the 30 years for a late action scenario for banks is an extra 110 billion of extra losses. But those are not distributed evenly over 30 years. Actually, 45 billion, just under half of those, arise in a 5-year period just after the transition happens. They're not distributed evenly across sectors. A lot of those risks are concentrated in those risks that are more subject to transition. and they're not evenly distributed in regions. So it shows that there is a huge amount of concentration of risks in different areas that we need to be aware of as we think about how financial stability risks can arise. If you go on to the next slide, please. I just wanted to make a really important point as well on the differences in modeling of risks, because this is fundamental to understanding. So we need to understand that when we look at these numbers, there is a huge amount of judgment that goes into the modeling, and that can have a significant impact on the outcomes. What this chart shows is that when you've got two banks that had the same counterparty and all the same knowledge, all the same information about how to model the risks in that counterparty, one institution modeled for the same scenario that the levels of impairments would be 10 times lower than the levels of impairments modeled by one of its peers. And the reason for that is that each of those institutions used the data in different ways and made different judgments on that data. And as a result, they came out with different numbers. So it shows that the challenge that we have as central banks to understand where those differences are and think through how we can help to bridge those differences. And that is a really big challenge for us, because we need to do this quite quickly in order to understand risks. So very important that this exercise has shone a light on that. We suspected it, but I think this has really helped to confirm it. The next slide, please. And what this slide just goes to, I think, demonstrate my point before, that risks are not evenly distributed. Some sectors, such as the manufacturing, such as the oil and gas sectors, will be materially more impacted from transition than others. Some sectors are impacted by transition risks and physical risks. So what we need to think about is, how are those impacts going to happen, over what period? And will that create an issue for institutions in terms of the capital held by institutions to be able to absorb losses as these sectors incur more impairments over time? But also from a financial stability perspective, what is happening in the system? Is the funding and the impairments to these sectors going down at a rate that cannot be supported by the system, i.e. that there's not substitutes in place? Because if you remove funding too quickly from certain sectors, and if the impairments are too high in those sectors, then they might cease to operate. If they cease to operate, you have a disorderly scenario. And if you have a disorderly scenario, you might have a gap in supply. And in a way, what we're seeing is a microcosm of that with the current energy supply. By a number of countries going to cut out energy from certain areas without substitutes in place, what you have is a supply gap, which means that you have an elevation in prices that needs to be adjusted through other policies. Next slide, please. And actually, I think if we just jump 2 more slides in the interest of time. And 1 more. Thank you. What this slide shows is on our final objective about business models. And the key point here is that we asked firms through the scenarios what they would actually do in terms of how they would look to shift their business models, which industries they would look to fund less and which industries they would look to provide additional funding to. This is really, really important, because this looks to how banks and insurers are operating within the transition framework. What we found was that individual institutions are making decisions about where to put their funding, but those individual decisions might not be cognizant of what's going on across the whole economy. Now, that's justifiable in a way, because we don't have a transition path. So these institutions don't necessarily know what the rest of the economy is doing. So it says to us that it's important that we build up our understanding of the whole economy transition. So decisions on risks can be made with a view to what's happening across the whole economy. And the next slide also speaks to this. It shows that where you have some major winners from the transition, but some major losers. And from a financial stability perspective, if the funding goes from those losers to the winners in a disorderly way, it creates an issue for us through our financial stability lens. Now, a couple of quick points on what this means for us as central bankers as we take our actions forwards. If you could just skip forward 2 slides, please. I think the first thing to flag is from a micro-prudential perspective. What the CBES has shown us is that firms are making steady progress in understanding climate risks, but there are fundamental challenges. So for us as a micro-prudential supervisor, we really need to ask ourselves, are firms going quick enough? Are they being ambitious enough? Are they investing enough to address those data gaps and modeling gaps, or are they not? And this is one of the areas where we have a constant discussion with firms to ensure that we understand what they're doing, understand whether there's areas that we can help them, where we can seed best practice in, but also for firms that aren't doing enough, that we can seek to get them to move quicker. And on this slide, I've just set out the work that we're doing on our supervisory side of the shop to try and make sure that there's enough progress in this space. And one of the things that we're thinking about at the moment is how can we collate all the information that we have as a central supervisor and disperse it across the sector to ensure that everyone's moving as quickly as they can. On the next slide, I just touch upon something that Cornelia and Fernando have talked through in some detail. It's really, really important that we understand whether firms are resilient to the risks that they are running. And that speaks to capital, amongst other things. There's a hugely live debate about whether capital should be used for the management of climate risks, either at the micro-prudential or macro-prudential level. And in a report last year, we put out our analysis of this space, where we said, that it was obvious to us that capital should be used for the consequences of climate change, but not for the causes, i.e. The policy to address climate change should sit elsewhere. We identified that some climate change is already caught in capital regimes, but there are gaps, and filling those gaps is complex, and there's a gap at the moment where we need more research. So there's a lot of international debate in this. What we will seek to do to try and harness and focus on that debate is we're holding a capital conference in the 19th and 20th of October. And in that, we want to really dig deep into some of these big questions that we need to answer. For example, over what time period should you be capitalizing for climate risks, given that they continue to rise for decades? How do you deal with climate risk uncertainty that is greater than other areas of risks? And where these risks are present, where should they be reflected in the capital framework? Should it be in the micro-pru side of the framework or the macro-pru kind of buffer side of the framework? And I should say, speaking to the previous points made by the previous speakers, there's a lot of support for both. That you can argue, as far as I've seen through research, that climate and capital should be reflected throughout the different parts of the capital framework. So that's a very live debate that we should get more clarity on through the course of the year. And then finally, my last slide. It just speaks to the need for us to build a financial system that creates clarity on what a transition would look like, that allows a whole economy transition to work in a way that minimizes risks. In a perfect world, we would have government clarity for all of the globe that sets out what transitions look like. Pragmatically, that's not going to be with us for a while. So building out tools, particularly disclosure tools, that are consistent, that build upon the work that's being done by institutions such as the ISSB, which is the IFRS Foundation's Sustainability Disclosure Group, looking at how we can develop transition plans, not just in the financial sector, but in the real economy, and building out other disclosures. It will allow us to build the ecosystem that then gives the information that we need to be able to manage risks in a coordinated way. Without that coordination, I think it's important that central banks look at what risks could arise, how disorderly scenarios could arise, and then think through what steps we might need to take, what tools we might need to utilize to manage those financial stability risks, not only as they crystallize, but before they crystallize. I think I'm out of time, so I will stop there, but would be happy to answer any questions. Thank you.
Wonderful. Many thanks, Chris, for your thought-provoking presentation and bringing out some very interesting results in terms of the importance of the scenario analysis and what has come out from that work. So we have now finished the 3 presentations in that great central bank tradition, all of you have been parsimonious, and we've actually completed this work ahead of time. We will now therefore turn to our next two discussants, one from the Monetary Authority of Singapore and the other from the Asian Development Bank. Building on the three presentations, it would be great if we can hear their comments and views from the perspectives perhaps of Asia and Asian DMCs, developing member countries. Our first discussant is Ms. Darian McBain, Chief Sustainability Officer of the Monetary Authority of Singapore. Darian, the floor is yours. Thank you very much.
Thank you, Bruno, and thank you very much for having me here today. Hello, everyone, and it's certainly been an amazing three presentations to take us across such a broad area, but I think it really demonstrates that when we're looking at climate change, there is no one silver bullet, there's no one answer, and that we need to address the risks from a number of different perspectives and also take in existing information, but constantly take in new information as well. Now, I'm going to share my comments, but with a health disclaimer to start. So I'm the Chief Sustainability Officer for the Monetary Authority of Singapore. As many of you know, we are an integrated financial regulator, so have a much broader remit than many of the central banks. And I spend my time going across all different aspects of what MAS does. A lot of my time is doing work that Chris just mentioned, actually working with the real economy, looking at how we can get better quality data on which to make financial decisions, particularly ESG data. And certainly I'm seeing a difference in the discussions that are taking place at the financial level, the financial industry, the central banks, and then the real economy. And that is something that we are going to need to bridge. And particularly, I think data is one way that we'll do that. Now, because I am not a technical expert in these areas, I have canvassed across MAS, so you're getting the expertise not just of myself, but of many people within the Monetary Authority of Singapore, and the comments on the presentations that we've had. So I think today we heard a number of important points across this whole spectrum. And firstly, on potential macro-prudential tools. The speakers today touched on climate scenario analysis as well as the Basel Capital Framework. Chris outlined the Bank of England's multi-pronged efforts to address climate change, including through recently conducted climate scenario analysis exercise. And given the uncertainties associated with climate change, scenario analysis was always going to be useful for assessing potential impact of climate risks and any of those broad potential pathways. Like Chris noted in this first slide, the approaches to address climate risks will also have to evolve over time. So this is a constantly evolving space. Fernando also touched on how within the Basel Capital Framework, Pillar 1 adjustments are particularly challenging. So this aligns with what Chris shared, that the Basel Capital Framework as it stands can partially address financial risks posed by climate change, but there are more complex risks that we also need to address. Second, the speakers also shared potential macro-prudential tools for the banking sector, a topic which remains very nascent at present, although nevertheless has generated much discussion among the supervisory and regulatory communities. As Cornelia emphasized in her presentation, the calibration of such tools will be highly challenging, not at least due to the significant methodological and data gaps that we're presently facing in climate risk assessment. Moving forward, it'd be important to develop a richer understanding of how such tools could interact with existing policy instruments to serve other important policy objectives as well as price and financial stability. Building on these discussions, I'll outline a few areas in which supervisors and regulators could focus on to deepen our understanding of climate risks and in turn to enable a more robust discussion on the potential enhancements to our microprudential and macroprudential policy frameworks. First, as Chris has also shared, it would be critical for supervisors to further integrate climate risk into their supervisory frameworks and practices. Environmental risk poses potential financial and reputational impact to financial institutions that requires actions from them to address now and looking into the future. Reputational risk and credit risk have already started to materialize, which gives us a certain sense of urgency to these actions. There's a consensus on the importance of this work at the international level. The NGFS in particular has taken the lead in proactively identifying and recommending good practices to uplift the collective supervisory approach in this, and the initial issuance of guidance for supervisors in 2020 and subsequent follow-up areas with the progress report last October on rapidly evolving practices in this area. Standard setting bodies have also taken action, and we heard a few references to those. So meanwhile, in Singapore, MAS has set out our supervisory expectations through our environmental risk management guidelines for banks, insurers, and asset managers. We've also provided further guidance on the financial industry through issuing information papers on our environmental risk management guidelines this May to highlight the emerging and good practices by FIs and where further work is needed. So we really think this is a journey that we all need to be taking together. Looking forward, supervisors will need to continue staying abreast of emerging good practices in the industry and closely engaging with FIs on their progress in addressing climate and environmental risks. And I think that's to say nothing of those broader environmental risks, such as with nature-based risks or a just transition. So secondly, we heard earlier from other speakers about climate scenario analysis as a useful tool in risk assessment. At the NGFS, Cornelia and her team have been driving critically important work in developing climate scenarios for the purpose of such scenario analysis efforts. Early this month, the NGFS published the third vintage of the NGFS scenarios, which were updated to reflect recent climate policy developments, as well as refinements in modelling methodologies. Moving forward, supervisors and regulators can continue to build on good practices identified in these exercises so far and iteratively improve future climate scenario analysis efforts. If we look to transition plans, beyond climate scenario analysis, supervisors need to be able to engage FIs on their progress in addressing environmental risks and in transitioning towards a low carbon economy. Transition plans are going to be a key tool, we believe, that can be used by FIs to steer their transformation amidst this rapidly changing environment. Financial institutions can also use firms' transition plans, or the lack thereof, to engage them and support their clients and customers as they transition towards alignment with science-based transition pathways. Regulators and supervisors are continuing to advance their thinking in this area, and given the broad reach of such plans, which go well beyond addressing risks and include changes in FI's business strategy in response to changes to the global environment. As the speakers have also rightly pointed out, we also need greater transparency and access to data to support our understanding of the risks involved and the progress that's being made to address them by comparable, consistent, and reliable sustainability disclosures. The global baseline disclosure standards to be issued by the ISSB will hopefully promote convergence on disclosure standards and enhance the usefulness of those disclosures. At MAS, we're looking at how to consult the industry on mandatory disclosure requirements for selected financial institutions, referencing the ISSB standards next year when they're finalised. Global regulators also will have a role to play in supporting increased disclosures, both by FIs, as well as exerting influence to support increased disclosures from firms and the corporate sector with their financed emissions routes. So in conclusion, climate change, as well as the transition to a more sustainable future, will have wide-ranging and complex implications for our economies and financial systems. Supervisors and regulators have a key part to play in ensuring that both individual financial institutions, as well as the overall financial system, will remain resilient to such risks. While we don't have all of the answers now, the supervisory and regulatory community has been making meaningful progress to deepen our understanding of this area across many fronts, as evidenced by the thoughtful sharing of the various speakers today. Thank you.
Thank you very much, Darian, for a comprehensive and thorough set of discussion points. Really appreciate it. Next in line, we have my colleague Jung-Kyu Lee, Chief of the Financial Sector Group at the Asian Development Bank. Jung-Kyu, over to you, please.
Thank you very much, Bruno, and also thank you very much for all of these very wonderful presentations shared in this the joint webinar. Before I go into some of my views and also the perspectives, and me actually as a G20 advisor a long time ago in 2009, 2010, couple of years, and I had some privilege to be involved in the making the G20 finance ministers level macro-prudential policy framework. And so I think this is very, very important topic. And from my experience, especially earned from the global financial crisis, and also the two things I really like to share right now is in the global financial crisis and the regulators and prudential policymakers and regulators and supervisors, and they were behind to catch up the emerging risk at the time. So when the crisis took place and actually everybody is asking a question, what are you going to do? And then we go for this policy framework and, including financial sector reform together. But now, when we are dealing with this, the risk, and when the world is moving towards this, addressing the climate change, the regulators and supervisors and the policymakers are really already taking steps, including the research and also policy, making the policy framework and also listening each other and sharing this knowledge. I think this one is really a good the opportunity and to compare to the global financial crisis, because the current discussion is really happening in tandem with, not much of delay, and in tandem with this, the world is moving. So I see this is a one good point. Second point is that, interesting enough, and compared to the global financial crisis and then the world response to the global financial crisis, and we have more opportunity to discuss the DMCs. We call it DMCs, ADB. DMCs, developing member countries, and ADB is serving. So we have more opportunities to serve our DMC's perspective, and given this very important policy framework discussion. So I think those 2 points, and before I get into this, some of the slides that I prepared, it's a kind of the two big things I'd like to share with my colleagues. And then the overview, what I'm going to do today is a kind of, I think I really like to build up the stories today. It's some sort of storyline and the connection between prudential regulation and greening the financial system, and greening the financial system and the prudential regulation. So the connection is very, very important. And between these two, let's move on to next slide. Okay, so this connection is very important because it provides the important policy incentive and also understanding from the people and from the industry and working together. So here is the next slide, and the prudential regulation, how this prudential regulation is related to greening the financial system, and also how this greening the financial system is really important for the prudential regulation, because greening the financial system is a response to global drivers, and such as the Paris Agreement, and also ambitious policy goals, commitment to address this climate change. And then this micro and the macro-prudential policies, especially for respectively micro-prudential policies for individual financial institutions as soundness and resilience, and macro-prudential policies is for the whole systems of soundness and resilience. So we really want to develop the storyline and connection between this prudential regulation and greening the financial system. And this connecting the storyline and gives us many perspectives from the DMC's perspective, and also because of the ADB's very unique position and serving these DMCs as a development bank and also the climate bank. And we can unravel many stories and from this connection actually. And then let's go next. And the next one is actually risk and opportunities. And my colleagues already talk about a lot about risk, but I would like to talk about as not only for the risk, but also opportunities. And because of ADB's unique status and serving this as a development bank. So here opportunities is resource efficiency and energy source, diversifying the energy source and introducing the new technology, and also the enhancing the products and the services, and also in terms of the market, access to the new markets and also access to the new assets. These are the very, very the important area we want to keep in order to move forward in the next slides and opportunities part. And next slide. And then we heard from our central bank colleagues in BIS and ECB and also the Bank of England, and with the policy framework, and and what kind of policy, what kind of pillars, and what are the current the preparations for that. So the question to DMCs is how to manage this climate-related financial risk right now and also over the time. And the here is we know that the banks are potentially exposed to climate-related financial risk, but the question is all banks in Asia, and also because when you say the banks, it's just domestically systemically important banks and regionally systemically important banks and globally systemically important banks. But we know this statement, banks are potentially exposed to climate-related risk, regardless of the size and complexity of the business models. And then from the DMC's perspective, and each individual country's DMC's perspective, how we can handle this bank's exposed risk, it might not be the one size fits all. So that is a kind of question, and we would like to discuss here. And for example, FSB already laid a roadmap in 2021, including these firm level disclosures, data, vulnerability analysis, and regulatory and supervisory practices. And today we discussed many times about the data gap, for example. And then also the firm level disclosures, and these firm level disclosures, who is going to help these firm level disclosures? Very, very, very interesting in the fundamental questions, and by accountants and by lawyers or expertise on this area. And do we believe that least developed countries already have a well-established these kind of expertise and in releasing and disclosure this firm level firm level exposure data? I think that is also the question we would like to ask. So here there is a roadmap, but in terms of the applying how to managing this climate financial risk, and each individual DMCs and also Asian DMCs and probably have a very different capacity and a very different fragmented approaches. So here, and for example, this BCBS also set out these principles. These set out these principles. And when you look at this BCBS members and how many Asian the countries under this the BCBS member at the moment, and from Australia to Malaysia, it's 9 the members are 9 out of these 28 jurisdictions are the members. So how about other DMCs? And do we listen to their DMCs' views about this specific ways of the managing climate-related financial risk? And from this roadmap and from these principles, I think we are working on that area. But at the moment, and I think we would like to put further effort into work together with the DMCs and regulators and understanding and their own specific challenges and also how to enhance their capacities. And I think it's a very important area. And then let's move to the next slide. And this slide is I have no intention to jump into the differences and whether pillar 1 is more important or pillar 2 is more important or pillar 3 is more important. We think it is all 3 approaches are very important. And from our DMC's lessons and earned from the global financial crisis, and many DMCs, and since the 2010 aftermath of the global financial crisis, and many DMCs already set up and financial stability, their own financial stability council or their own financial services, the commissions, and who is handling these the systemic risk, and with the central bank or Minister of Finance. So at the moment, in terms of the understanding about this macro-prudential, the need to approach using this macro-prudential policies or framework, I think it's a pretty much and the share then among these DMCs because of their experience and during the last more than a decade, the policy and the framework and applications. So we believe that this micro-prudential policies and the macro-prudential policies are well complemented each other. I think it is very, very important, and those complementary roles. And then the next slide is the how to redirect the financial flows. And I think this is also a very, very interesting question. I think the important thing is that the transition policy, importance of the transition policies, importance of transition measures, importance of this finance for the DMCs. For example, the risk environment at the moment is very dynamic. And we know there should be the need for financing, and also there should be the need for the pilots and a lot of experience. It's not just 5-year time horizon, it is a 20 years and 30 years. And also we have existing technologies and new technologies, which we don't know, and also the prudential measures for the stabilities there. So how we can make a balance, this is also very, very interesting questions. And then these all of ideas are at the moment far from carrying unanimous backing, already explained by our colleagues. And so I don't need to go into the details here. And so the importance is that how do we make the balance and between these handling this dynamic risk environment and then the prudential measures. And the next slide, and there are specific views on green, micro, and the macro-prudential policies in relation to climate-related risk. And when you look at this ASEAN report, and it says ASEAN report shows that we are at the early stages of understanding and also exploring and also adopting. So I believe that there should be, based on this report, and we can say that there should be the roles of the ADB and serving these Asian DMCs. So some of roles we think it is that we need to put improving tools to assess vulnerability and the climate risk exposure, and also supporting and facilitating climate change operation and action framework, and supporting DMCs to integrate these risks into the capital framework, also very, very important. And all of these one, and another thing is that the regional cooperation and together with the global level cooperation, there was a discussion already stressed by our presenters, importance of this regulators collaboration and also importance of some sort of the international guidelines. And because of this region is closely connected and based on this supply chain and this trade, services, financial markets are very, very closely connected. So these micro and the macro potential discussions and at the regional level cooperation and the regulators, the beginning to consider this kind of collaboration on the framework and direction, we think it's a very, very important. And then let me go to the last slides and to wrap up. And it is important that the prudential regulation could help facilitate the distribution of the credit flows across sectors, and also integrating risk into financial risk frameworks. And it's very, very important. And also the importance of ensuring transition policy framework and the financing mechanism for DMCs. And over the time horizon, because not only for the concentration of the risk and also the vulnerability of the risk over the time, it's a important the points to consider. So this one should be stressed, and then the MDBs like ADB and can play a role in this process to help and DMCs facilitate these new flows and also they manage this financial risk. Yeah, I will stop here. Thank you.
Thank you. Thank you very much, Junki, for those points. We have slightly under 10 minutes now. We would like to now open it up to Q&A. You will have seen there are a number of questions on the chat box, but let me begin by asking Professor Shirai if she'd like to raise a question. Professor Shirai.
Yeah, thank you very much. I enjoyed all three presentations. But I have a question to the speaker from ECB and Bank of England, because I happen to see your stress test and also climate exercise report. Now, I think ECB mentioned clearly, but in order to make this kind of a stress test very useful, we need to get the Scope 3 data of the counterparties and companies. But in practice, it's very difficult to get this Scope 3 on the corporate sector level. And I think ISSB is trying to stress about this Scope 3 disclosure. But I think there's a lot of criticism and concerns raised about that. So, and also in Asia, I think many Asian corporate sectors are reluctant to provide suppliers emission data. Traditionally, they don't want to give pressures. So how do you think we can promote this Scope 3 type disclosure? Chris mentioned that there is a lot of banking sector have a different judgment, but they have a different judgment partly because data is not enough. So this is my first question. The second question is that so when we do climate tests, we can follow NGFS 1.5 degree scenario. But then some countries have a different climate policy. Because many Asian countries, we rely on the fossil fuel and coal. And even after net zero, I think many Asian countries still depend on coal-financed electricity. So what we are thinking is that we want to cut emission by using CCS, CCUS, or hydrogen technology, which are very costly and not really commercialized yet. But that is a lot of countries' scenario. So under this scenario, what happened to commercial banks? Now, commercial bank in Asian country, maybe they think, fossil fuel is a part of green activity, whereas in Europe, it's not acceptable. So I'd like to get your opinion about this difference coming from climate policy of each government. Thank you.
Thank you very much, Professor Shirai. Cornelia, Chris, 2-minute replies from you, please. Thank you.
So maybe I start. Thanks very much for the question, Professor Shirai. So it's true, the data, getting on your first question, so on the data availability, it is really a challenge also for us. So we very often rely on data providers. And so we are doing some work to improve the scope 3 data, because they are really an important input for estimation of transition risks. And yeah, as I said, we are still in the process of trying to understand better. Thank you.
Thank you. Chris, would you like to chime in? Thank you.
Yeah, and just to build on that, so it's clear that scope 3 data is incredibly patchy at the moment. A lot of that scope 3 data needs to come from the real economy. A lot of the areas that are being focused on are in the financial system at the moment, but the financial system can only mirror what we're seeing in the real economy. So we need to make sure that there's a whole economy set of frameworks that are set up to get that information, because there's a lot of sectors that just aren't collecting this data at the moment. I do agree that scope 3 emissions are incredibly useful, and they will be an essential tool going forwards. But I do caveat that they are not a proxy for risks. So something can have, an institution can have high scope 3 emissions, but it might not be subject to high transition risk, because it might be, I don't know, an aviation company that has no substitutes coming forward. And there could be institutions that have very low scope 3 emissions that could be very vulnerable, because they could be a tech company that could be made obsolete. So we use scope 3 emissions, we advocate for their collection, but we are cautious about using them as a proxy for risks in our analysis.
Very good. Thank you very much for those answers. I'm very much aware of time. We have maybe time for one more question from those questions that have been submitted. There is a question by Pierre Monin, and it could be answered to both Fernando and Cornelia. I see Fernando has his hand up. Given the insights you highlighted from the European case, which macro-prudential instruments, i.e. systemic risk buffer, concentration limits, would be more adapted in Asia? What dimensions should Asian supervisors focus on to decide which instruments to use? So Fernando, if you'd like to go first, and if you had some points on the previous question, please in 2 minutes, and then we'll turn it to Cornelia. Thank you.
So thank you very much for this question, because it allows me to clarify something that came out, particularly in the presentation by Cornelia, whether this is the balance between micro-pru and macro-pru, whether there is a scope or not for macro-pru type of action. So we try to explain a little bit what is our take on this. So we have macro-pru policies typically need to target basically 2 objectives. First one is to increase the resilience of the financial sector when facing macroeconomic risks. The second objective is try to address directly actually those macroeconomic risks, try to mitigate those risks. So you take, for instance, traditional macro-prudential framework, you observe some particular macro risks, macro imbalances like excessive credit growth or excessive housing price growth. Then basically you can apply macro-pru policies to increase the resilience of the financial sector, sort of keeping in mind the possibility of a sharp correction of those macroeconomic imbalances, right? So this is the first objective. The second objective is more direct. It's trying actually just to mitigate those imbalances to continue building up by reducing, for instance, credit, by mitigating credit growth. So it's important when we talk about the macro-pru framework that we have to take into account those two objectives. The first objective, resilience, is not the most interesting one, because resilience is also the objective of the macro-pru policies. So it's just a matter of actually sort of deciding whether this particular instrument is more helpful than the other instrument to increase resilience, and whether we call one instrument macro or micro, which, by the way, is not clear-cut. For instance, the capital conservation buffer could be seen as both micro-macro, or the concentration limits could be seen as macro, but also as micro, as part actually of pillar 2. The most interesting, actually, objective macro-pru policies is the possibility actually to lead regulation to mitigate those macro risks. This again happens in the traditional macro-pru policies, but it's extremely hard when we talk about climate. And I think Cornelia, in her presentation, clarified that almost all macro-pru instruments may have actual impact, a positive impact in what respect to resilience. But it's not obvious actually that you can actually sort of identify good macro-pru type of instruments to mitigate either physical or transition risks. On that, I think that we fully agree, right? And that is why we cannot actually ask regulation to basically to address directly actually climate-related financial risk. We can address obviously implications of the risk for the safety and soundness of financial institutions, but that's all we can have. That's a completely different environment to the one we normally take into account when deciding the traditional macro-pru policy.
Thank you, Fernando. Cornelia, maybe the last word for you. Thank you.
Okay, thank you very much to the other presenters, and also for the question. So how can we adapt macro-prudential instruments in Asia? So I mean, I think country by country, the macro-prudential frameworks, they really differ. So it's not easy to give one size fits all answer. And also the study that I explained earlier on, I'm sure some of the results would also hold more or less for many of the Asian countries, but some others may not. So I think the way to go would be to conduct similar studies to understand where are the concentrations, where are the interconnections between the different parts of the financial sector. So in Europe, as I said, we have the systemic risk buffer, which we think could, for instance, be a good tool to address the climate risk. So maybe there's a case for creating similar type of tools across countries. I mean, and maybe as my last word, so in the NGFS work that, by the way, Chris has been very involved with in the years before the ECB took over and sharing the work stream 2 on scenarios. So there we found that Asian and also African countries have actually a very high degree of physical risk to shoulder. So I think it's something to really look into going forward. And let me at just a moment just then also promote the NGFS scenario work. It was mentioned before that we published the 3rd vintage of scenarios just a few weeks ago, and we hope that they are also really used in particular by regulators and supervisors to understand the possible effects of the different scenarios. Thank you.
Thank you very much, Cornelia. I am aware that we're about 3 minutes past our time. I wanted to thank all the 3 presenters and the 2 discussants for a fascinating and most insightful of discussions. Certainly, I've learned a lot. For those of you who had questions in the chat box and we were not able to cover, we will certainly send it to the presenters via email. And if they are so kind to give their thoughts, that would really appreciate it. Now it is time to wrap up on this 2-day event, and we have kindly asked Professor Shirai to provide some closing remarks. So over to you, Professor Shirai. Thank you.
So yesterday, for one day, we discussed about blended finance and its importance to bring a public fund and mixing with private capital. And especially, we like to mobilize ESG type investors. So a lot of activities happening, ADBI, ADB, and IFC. There's a Green Climate Fund created by UN. But I think we still need a lot of money which can take fast growth. So that is a challenge. So today it was a very interesting discussion among all prestigious central bank, and I think we know things are improving. And this stress test, macro-prudential, micro-prudential, a lot of discussion, but I think we need to fill out the data gap, and how to standardize risk assessment methodology is essential. But the important thing is we understand the issue, and I think we will see more improvement in the future. Thank you.
Thank you very much, Professor Shirai. So with those closing remarks, I bring this two-day conference to a close. Thank you very much to everyone for participating. Have a nice day.
Thank you.
Bye-bye.
Bye-bye.